Hello, everyone. Thank you very much for joining us today. My name is Corey Daharsh, and I'm here with Advanta IRA to bring you guys another educational webinar. Today's topic is Discover How Mineral Rights Can Boost Your Self-Directed IRA. And my guest speaker today is Thomas Lorance. He is with Eckard Enterprises. They are an oil and gas investment provider. We've been working with them for a number of years. I've got both of our contact information here on the screen. I'll also display this later on in the presentation. Thomas, thank you very much for joining me today. Is there anything you'd like to share with the audience real briefly just about your background and experience in your industry?
Yeah, well, first, thanks for having me on. I'll just tell you real quick. I actually spent a few years working on these drilling rigs out in West Texas, so pretty familiar with the process of getting this oil and gas out of the ground. Also spent some time just prior to coming to Eckard as a financial advisor. So this is probably the best, most perfect combination of those two things that I could find myself doing. So yeah, just excited to be here and kind of share more about this. I know a lot of people don't know too much about the oil and gas industry, so pretty exciting stuff.
Awesome. Well, thank you very much. I noticed you have a 321 area code. Are you from Central Florida originally?
I am, yes.
Okay.
No.
Go ahead. You live in Texas now?
Yes, outside of Dallas.
Okay. I'm from Brevard County as well, so my personal phone's a 321 also. But these are cell phone numbers if anyone wants to reach out either via phone, email, or our websites respectively are listed here too if you want to learn more information. Without further ado, I'm just going to give you guys our agenda for the day. I'm basically covering the background on Advanta IRA and the basics of self-directed retirement account investing, just the common rules, regulations, how to get these accounts funded. Actually, number 3 there, that's a misprint. It shouldn't be case study in there. I've removed that. That was from a different webinar I pulled this agenda slide off of, so I apologize. Actually, this isn't updated at all. I was having some tech issues, everybody, so I apologize. If you want a copy of the slide deck, I'll provide you an updated rendering. But what we will have in the main course of this presentation is actually Thomas covering Eckard Enterprise, the background of the company, a few different strategies to invest into oil and gas type investments, some of the history of the industry, and then commonly use Roth conversion strategy that they know about and they talk to their clients about, as well as Advanta IRA. So that's going to be the agenda for the presentation. Sorry about some of the slides here. Again, I was having a tech issue right before the presentation, so I guess my updates that I made earlier in the day did not carry over. Backgrounds to Advanta IRA, we've been in business for 21 years. We've got about 15,000 active clients and just over 3.4, right at 3.5 billion in assets under administration. Each of our clients have a dedicated client account manager appointed to them. So when you have an account with us, you have a one-to-one white glove customer service experience. You're not having to deal with a call center and asking a new person every time that you want to do something with your account, how to do so. It's always going to be the same person, so you build continuity. They have built understanding of how to answer your questions effectively and how to help you with the strategies and investment structures that you're looking to place your retirement dollars into. Now, a brief disclaimer, I'm sure Thomas has something very similar on his portion of the presentation, but we are here to provide educational content. So I'm not a tax expert, a financial expert, or a legal expert. I'm an expert in retirement accounts and specifically self-directed investing strategies. I do implore everyone before you actually make an investment in a self-directed account to consult with your own team of CPAs, attorneys, tax preparers, whatever your team looks like, as a full due diligence process. Because keep in mind, this is not a fiduciary or a financial advisory type account. This is a self-direct account. So you ultimately control and have the keys in your hand to make whatever investments you deem appropriate with your retirement dollars. So what is a self-directed IRA? For those of you that aren't familiar at all, it's basically a retirement account that lets you invest into just about any asset class under the sun that you may want to invest into, whether it's a new thing you're wanting to get into, or an investment strategy you've already been doing with your savings that you learn you can also do with your tax sheltered retirement funds. So this extends to real estate, oil and gas, like we're here to talk about today, cryptocurrency, precious metals, private lending, a lot of different things. And in the next few slides, I'll cover the actual rules so you get a better grasp of what you can or cannot invest into. So if you haven't heard about self-directed investing, it's actually very common. Only about 4% of US-based retirement accounts are self-directed right now. And that's an industry hovering around $40 trillion. So of $40 trillion, only about 4% is actively being self-directed. And the key reason for that is people just don't know that it exists. A lot of times you have a fiduciary or a financial advisor retirement account, and they tend to lean in the favor of telling you, oh, it's too risky, it's too scary, your money's safer in my hands, where I'm charging you a flat rate fee or points on your investments or interest on the investments that we guide you to. And a lot of people are not really happy with the stock market, those stocks, bonds, mutual fund asset classes over the past few years as well, because if you are or are not aware, it's been a bit of a roller coaster ride for the past several years. So just a few, as I just mentioned there in the last few seconds, a few key reasons people switch over to self-directed accounts is they find that it's a new source of capital. So I've already been doing some sort of investment strategy, and then I learned that I can do that same thing with my tax sheltered retirement account that I've been building. People are fatigued with the stock market. And then the tax benefits of making these investments through a retirement account are that you're generating passive income that is either tax deferred, meaning you just pay taxes on it later in life when you actually retire and start using this money for personal purposes, or completely tax-free if you have done a Roth IRA or a Roth conversion at some point to basically pay the taxes on that money at that point in time and let it grow completely tax-free moving forward. So the rules around these accounts are very simple. It's actually easier to tell you what you cannot invest into than to tell you what you can. So basically, the IRS doesn't want you to use a retirement account to invest into life insurance policies or hard to value collectibles like antiques, fine wine, artwork, anything that's subjective in value are assets you should not really be holding in a retirement account. Some coins are allowed, as I mentioned earlier. Precious metals are an allowable investment, but it's typically not circulating currencies, and these are like the metals like American Eagle, gold bullion, those types of things that can be invested through a retirement account. Outside of those specific categories, you can pretty much invest in any other asset class you're interested in, but you are limited to who you transact with. So buying an asset from an individual or selling an asset to an individual or a company, or owning an asset and letting a individual or a company benefit from that asset, those are what's called prohibited transactions based off of disqualified persons. And the disqualified persons are basically your main trunk of your family tree. So your parents, your grandparents, your children, your grandchildren, yourself, your spouse, and any businesses that any of those individuals own or control day-to-day operations of. So you're not allowed to transact with those disqualified persons, but you can partner with them. That's a key distinction. You can be on the same side of a deal with that disqualified person, but you can't be on the opposite side of a deal from them. And then real quickly, unrelated business income tax sometimes applies, as does UDFI, unrelated debt finance income. Those are very nuanced investment scenarios. If you're looking into an investment that would apply to UBIT or UDFI tax, that's something your client account manager can answer and help you with. It really doesn't apply so much into the topics we're here to talk about today, so I'm not going to dive too deeply into that. Here's a brief illustration on the disqualified persons rules I just mentioned, and I do want to distinctly outline that your siblings are not considered disqualified. Aunts, uncles, cousins, in-laws, other distant family members, friends, business colleagues, none of those individuals are disqualified. So you can transact with those individuals, just staying away from being on the opposite side of a deal of anyone on this illustration here, or that I just outlined verbally on the last slide. So there are a number of different types of plans that can be self-directed. Most people are familiar with your traditional or your Roth IRA, but separately inherited IRAs if someone's passed away and left behind their retirement account to you, health savings and education savings accounts. And for small business owners that are either self-employed or have a very limited number of employees, rank and file employees, You can have a solo 401k or a SEP or a simple IRA. My job on the onboarding side of things is to talk through with everyone when they're looking to set up an account, what their situation is, what their status is, and find what plan type is going to fit their needs best based on their employment, their intended contributions into the plan. There's a number of different factors, some of the investment strategies that they want to do. Some plan types are better than others for, but that's kind of my job on the onboarding side, is to help determine what plan type is best for you, and not just throw you into the easiest, quickest plan that you can get set up with. With self-direction, it's very important to find the deals with the people that you know to build your network, whether it be attending local investor meetups or participating in educational webinars like this and reaching out to some of the guest speakers you hear. It's very important to build that triad of know, like, and trust before you invest. As I mentioned on my disclaimer slide earlier, you have the complete keys of your retirement in your hands when you're self-directing. So it's completely up to you. You sign off on any investment that's being made. So it's very important that you're doing thorough due diligence and very comfortable with the people that you're turning your money over to for whatever investment strategy you may want to make. So getting started is very easy. It only takes about 10 to 15 minutes to complete an application. We get the account open and funded within about a week to a week and a half's time, depending on where your funds are coming from. That's all stuff that I'll walk you through and help you with at the onboarding point of starting everything up. And then getting the investment done, it really takes about 2 days once we know what investment you want to make to actually execute the transaction and process the investment. So it's a very quick process. It is non-taxable to move your money from an existing account over to a self-direct account unless you're choosing to do a Roth conversion. And it's, again, about a week and a half roughly timeline for getting an account set up and getting it ready to fund an investment transaction. Now I'm going to go ahead and turn over to Thomas for his portion of the presentation, but before I do so, I do want to let the audience know you will be muted throughout the duration of the presentation. I saw a few people attempting to use the hand raise feature. If you have any questions, I'm going to address those to Thomas as he's presenting, but you'll need to use the questions box on the GoToWebinar panel. So please use the questions box on the panel, and I will be watching those on my screen. As long as it relates relatively to what Thomas is presenting, or if he pauses in between to ask any miscellaneous questions, we'll go ahead and address them out loud for you guys. All right, without any further ado, Thomas, the floor is yours.
All right, thanks, Corey. Yeah, so just to kind of give us an overview, really first we want to talk about the company, so you know who you're investing with, what the asset class is, and then what kind of opportunity there is just in general, and then also the benefit of using your self-directed IRA in order to invest. So just in kind of getting into the company, you know, you typically, if you're, you know, just like Corey was saying, you want to do your due diligence. Your number one risk, in my view, is giving your money to someone that isn't going to actually do what they say they're going to do. So you want to work with someone that has a track record, someone that has the experience, the expertise to be able to appropriately manage those funds that you've invested. We've been in the oil and gas industry since 1985. So Troy Eckard, our founder, started off brokering other people's deals, had his own brokerage, did that until 1995, where he started his own operating company or oil company. So that's where you're actually hiring the engineers, the geologists, going out and drilling the wells. So it was drilling his own wells until about 2017. At that point, saw that it would be a good opportunity for us to transition from drilling wells ourselves to the mineral rights, and we'll get into what those minerals are. But our main focus has been kind of twofold. One, it is really studying the Anadarko and Permian basins. So that's Oklahoma and West Texas. And in our purpose in doing that is not only to know what are the best places for us to buy mineral rights, but also to find out what's working and what's not working when it comes to advancements in modern drilling. We'll touch on that. We'll touch on that a little bit, but for the most part today we'll be talking about mineral rights because that's what's most applicable to you guys in this meeting. Our company is broken up into 4 different divisions. So Eckard Land and Acquisition. This is going to be our mineral side. So it's with mineral rights, what we're looking at is something that's going to have monthly cash flow, asset protection, and preservation of capital. This is really where real estate and oil and gas meet. So when we go buy mineral rights, we're buying the right to, in our case, the oil and gas that's in the ground. There's mineral rights that exist all over the country. Anywhere you go, you could potentially be buying the minerals. If I was going to go mine for gold or coal or something like that, I would need to own the mineral rights. When it comes to Eckard Land and Acquisition, we acquire minerals in those areas that your asset, your mineral that you're buying is going to be oil and natural gas. Eckard Midstream is our pipeline company. So we acquired the 2nd largest gas pipeline in the Gulf of Mexico, Gulf of America now, I guess. We manage that. That is the transportation of gas from point A to point B, and we collect a tariff on each molecule that passes through our pipeline. Eckard Energy is our oil company, our operator. So we in studying the basin, saw the opportunity to get back into drilling. And so we were able to put together a dream team with all of the mergers and acquisitions that have been happening over the last year or so. We've been able to really cherry pick the best people to go drill our wells. So we're back to doing that in addition to the mineral rights. And then Eckard Enterprises is kind of the umbrella that sits over everything. With Eckard Enterprises, we offer from time to time we'll offer notes. So just not, and I guess I don't consider it really an investment per se. You know, it's a good place to park money for a few years and collect interest. So diving into Eckard Land and Acquisition. Yeah, so those are kind of the notes on that. But diving into Eckard Land and Acquisition, it's mineral rights. With this, we have monthly revenues for the next 20 to 75 years. Mineral rights, like I said, it's where real estate and oil and gas meet. Minerals are like kind with traditional real estate. In the eyes of the IRS, they're the same thing. And so in addition to having people invest through their IRAs, I'd say probably a third of the business that we do is people selling their rental property, for instance, and then doing a 1031 exchange into mineral rights. So like I said, it's like kind, you're able to do that exchange. Something that we love, that our investors love, is that there's no holding costs, there's no liabilities. Not usually what you're going to think of when you think of high risk oil and gas. You know, this is not that. A lot of the people that invest with us are real estate investors, and so being able to have no holding costs and no liabilities is a tremendous benefit when that's absolutely something that you're subject to with your traditional real estate. When we are putting together, say, a package of mineral rights, We are looking for a 10 to 20% average annualized return. So with oil and gas, as you've seen over the last several months, actually the last several years, it's a volatile market. There's going to be ups, there's going to be downs. To be able to predict what's going to happen next month is virtually impossible. And so you have to look at your average return when you're looking at this kind of asset. So diving into the actual investment, what this asset is. You'll go to the next slide for me, Corey.
Well, Thomas, I wanted to just interject with one quick reiteration of something you said here in that Eckard land and acquisition component. These are, in the eyes of the IRS, real estate investments. I have seen your team at several different conferences throughout the country in the past few years, specifically for real estate investors. So while it is, a niche area of the kind of real estate category, these are seen in the eyes of the IRS as real estate investments. So I want to make sure the audience kind of understands that pretty thoroughly. And then a question did come in from the audience that I'll just address to you before I bump to the next slide. Would we be buying the mineral rights on a piece of land that is part of a larger lot with other investors sharing the income from the larger lot? And then follow up to that or additional aspects. Is this for accredited investors only? Is there a minimum investment? How long after investing until we start receiving income and expenses, any expenses? Obviously, the tail end of that, you may want to redirect them to reach out to you directly, but just I wanted to read it out loud in its entirety for you to address.
Yeah, so I can just kind of crank through those real quick. Yes, this is an investment that's only for accredited investors. As far as how it's structured, that it's correct in that you will own a fractional piece of each. We call it each tract of minerals. So let me talk about what the minerals are, and then I'll address those other questions because I think it'll make more sense. It sounds like whoever asked that might have some idea of what this is already. I think it'll make more sense to everyone else if I talk more about what the minerals are and then get to those. So if I forget, Corey, if you would just pull me back to that question, the latter part of it.
Will do. Thank you.
Awesome. All right. So with mineral rights, it's kind of the opposite or looking the other way from traditional real estate. If I'm going to go evaluate an office building, I'm going to say how many floors there are, how many people can I fit into it, what is the rent that I can charge, and that's how I'm going to determine the value or whether I want to purchase that piece of property, purchase that building. For mineral rights, we're doing the same thing. We're just looking the other direction. We want to know how many zones or how many layers are under the ground, because that's going to determine how many wells we can put into the ground. So you'll see in this example, I'm just showing, I think I put 4 arrows in there illustrating 4 different zones that could be accessed. Now, if we go to the next button, it's going to show more that pops up underneath, more layers. Now, it's not that those layers are magically appearing like they are in this slide, but as technology advances and as commodity prices go up, it's as though we're finding more oil and gas in the ground because they become available. So it's not so much how much is there, it's how much can you access at any given point. So when I'm a mineral owner, when I buy the minerals, I'm not buying the surface. I don't care what's happening on the surface. I'm only buying the right to the oil and gas that is under the ground. I'm going to access that, or if I don't have the ability to, I'm going to lease those minerals to someone who does. But that oil and gas is going to be accessed through a drilling rig that's going to drill down, and it'll actually go underneath that piece of property and into one or multiple zones, depending on how many wells they put in. So let's just say I'm not going to drill my own minerals, okay? Because most of the people on this call are not going to do that. I own the minerals, okay? Think of it as being the landlord. I'm then going to lease those minerals to an operator or an oil company. Instead of saying I'll pay you X amount each month, our agreement is going to dictate that they're going to pay me a percentage for every barrel of oil and molecule of gas that they pull out of my minerals. Now, that's good for the entire area, not a particular well. So if they come back and they drill wells 2, 3, 4, 5, I'm going to get a royalty off of every single one of those new wells. So just like my office building there, I write the check, I own the building. Now my revenue increases every time I put a new tenant in. When I own minerals, I write the check, I own the mineral rights, and I profit from every new well that gets drilled. Now, unlike that commercial building, like I said previously, I don't have any holding costs. Okay, there's no insurance. No one's going to slip and fall underneath the ground and sue me. Okay, I own the minerals outright, and I don't have to worry about those other kinds of expenses. So we would say that this is probably the most well, let's say the safest way to invest in oil and gas. So when Eckard puts together an asset for you to invest in, we're going to do this over several tracks. Okay, so imagine, still comparing it to real estate, we go and we buy a percentage of multiple buildings, not just one. And when you invest, you're going to own a fractional amount of each of those buildings. So every time a new tenant gets in, it increases your revenue. We're doing the exact same thing with the mineral rights. So Eckard is going to use our cash ahead of you to go actually purchase the minerals. Okay, we don't use leverage or debt. We use our own money to go buy the mineral rights. So we're only going to buy those minerals that we want to keep indefinitely. Because if we go buy it and people decide, hey, we don't have an appetite for minerals anymore, then we are going to keep it forever. So we're highly incentivized to buy minerals that are going to do very well for a very long time. Anyway, we're going to purchase the minerals and build up our own inventory. We're then going to cherry pick the most appropriate minerals to bundle together into a package. We put out a new package every 3 to 6 weeks. Eckard is going to keep a portion of that package that goes into our portfolio, and then we're going to sell the remaining amount to our investing partners. We sell it to you for more than what we paid for it. That's going to allow us to pay the taxes on the asset that we just sold you. It's going to help lower our cost basis. We spend tens of thousands of dollars each month just to look at mineral rights. And then the remaining amount is what's going to actually be reinvested into buying the next bundle of minerals to add to our inventory. So that's really how we grow our business. But ultimately, we are profiting off of the exact same asset as all of our investing partners. So what we recommend is that investors do the same thing that we do. They take a piece of every single package that we put out. That's building more diversification into your portfolio, and it's giving you a bigger footprint meaning there's more area, more geographical space for these wells to be drilled in. So I'm essentially getting access to greater reserves spread out across potentially multiple basins. Okay. Corey, if you would ask me those questions again, and I think this is a good place to address this.
Yeah, so the questions on the tail end that came in were, is this for accredited investors only, which I think you already addressed? Is there a minimum investment? How long after investing until the investor starts receiving income? And are there any expenses for the, I guess, end retirement account investor?
Okay, perfect. So the minimum investment is $50,000 to start. Like I said, we recommend that you spread your investment out over multiple packages. And so typically when an investor comes in, they want to build a portfolio. They're investing at least $250,000 over the first 12 months so that way they can get into multiple packages. You go, project by project. So I don't take your money up front and then invest it for you. As new packages come out, you either make the investment or you don't. My job is to tell you how to be successful with it, and then you take that information and do what I guess fits in with your objectives best. You have about 180 days between the time that you make the investment until you see your first distribution. When we buy mineral rights and we bundle them together, every package is going to have active producing wells. What that's going to do is it's going to prove up those areas. We're not guessing on what's in the ground. It's also going to generate revenue from day one. Okay, you're not going to see those checks from day one because this is an asset that is title and deeded. We have to file those titles with the county. We have to have the operator, the oil company that's going to be writing us the checks. We have to have their ownership deck updated, and then they have to send us the checks, has to go through our accounting and then go to you. That process takes approximately 6 months to do. During that time that the wells are generating revenue, but you're not seeing any of that revenue, think of it as going to an escrow account. So your first distribution that you receive from us is going to be an accumulation of several months of production all at once, and then it'll drop because you're going to be going month to month from that point. Now I'll say when we are evaluating the asset, we're not trying to go out and buy a fully occupied building. We're not trying to pay a premium for immediate revenue. We're looking for a lower cost basis and plenty of upside. And so we're going to buy minerals that are proven, okay, that are very low risk, but we buy them with the intent that they're going to continue to grow over time. And that's why I said at the beginning, we expect these to last for the next 20, 75 years. Okay. What was the last question? I think I missed something. It was.
Well, there was one more that came in that same train of questions. And then, sorry, I'm scrolling back up to see it. The last one was, is there any expenses relative to the investor, or I guess due from the investor? And then an additional question that falls right in line with those that you're answering right now, is there a minimum holding time on these types of investments?
Good question. All right. So Eckard does not charge a management fee. So what you get is going to be a net return. Sometimes there can be fees that are charged, like transportation fees, something called a marketing fee. It's not for marketing in the sense that we would think of. It's in getting the oil and gas to market. That's all taken out on an operator level before Eckard even sees the checks. So what we're all receiving is going to be a net return. So no fees. We make the money, our money off of the sale so that we can go grow the company, but the revenue that our company generates is really coming from those minerals. As far as a hold time, that actually gets us into how you take ownership. There's not a specific hold time. You're also not investing into an LLC or a fund. You're taking direct ownership of this asset, right? So just like purchasing real estate, you purchase it, it's yours. If you want to sell it, someone else has to buy it. So, we don't say hold it for 5 years and then, we buy you out or you sell your shares. You're actually selling the asset, and more than likely it would be to another Eckard investor. We set up what we call it our P2P, partner to partner marketplace. This is where people can put their mineral packages for sale. Most people do not. This isn't something that you want to, we'll say, buy in and then flip out of. If you're not going to hold it for 5-10 years, I'd say don't make the investment. This is a long-term investment, something that's going to generate revenue for a very long time, especially when you consider the typical 5 to 10 year hold period that you're looking at with traditional real estate. This is very different from that. Any other questions?
And a few other questions that came in, Thomas, if you'd like me to.
Yeah, let's do it.
Yeah. Can you talk about the availability of minerals compared to how many companies are drilling and extracting? And then the tail end, they just added the sentence, talk about the risk.
Good. All right. So availability, it is shrinking. So think of this, because it is real estate, think of it as like oceanfront property. Okay, there's only so much of it in the country, and once I own it, you have to pay me enough to justify me selling it. Otherwise, I'm just going to rent it to you, and you're going to pay whatever the market dictates. There's only so many places in the country that the dinosaurs went to die. We have 7 main basins in the country. The Anadarko Basin and the Permian Basin are 2 of the top 3 in the country. So what happens is, because we get asked, and I think that's kind of what this question is, if I have these big companies, why are they not buying the minerals themselves? And the answer is that they are. They're doing multi-billion-dollar transactions, whereas we're doing multi-million-dollar transactions. The arbitrage that we found is having boots on the ground, going, literally at times from door to door, talking to farmers, ranchers. Some people don't even realize that they own mineral rights. They just inherited them, and purchasing, 5 acres here, 10 acres there, another 150 acres, and then we bundle those together into a package. It's not something that an oil and gas company really takes the time to do, because it's not their main business. They want to come in, lease the minerals, pump as much oil and gas out of it as possible, and then move on to the next well. On the drilling side, and this is something that we do offer, it's just not appropriate for a retirement account, is working interest. That's where you're actually participating in the drilling of a well. When you do working interest, or when an oil and gas company drills a well, you're kind of on a treadmill. So you have to keep moving forward, otherwise you'll fall off the back, because the nature of a well is that it's going to produce its maximum volume up front, and then it's going to decline over time. And so in order to keep generating those high revenues and keep producing, oil companies have to keep drilling new wells. So they have to get to keep going. They don't have really the time to keep buying all these little assets. That's where Eckard comes in to be able to kind of fill that gap. When it comes to risk associated with mineral rights, I would say there's virtually zero risk when it comes to it. I mean, to be blunt, your biggest risk sitting in the chair that you're in listening to me is that I'm, trying to pull the wool over your eyes. Just like we talked about at the beginning, you want to do your due diligence. You want to know who you're working with. Your biggest risk is that we're good at making people believe that we know what we're doing, and taking your money and running off to the Bahamas or something. Outside of that, your risk is really just timing. When you own the oil and gas in the ground, you own an asset that every single person in the country and most everyone in the world uses every single day. And we have people even still will sometimes ask, what about green energy? What about electric cars? If we pulled every vehicle off of the road, that would only account for about half of a barrel of oil. The other half is going to go into manufacturing, is going to go into the products that we use. You look around your room, everything in there has either been transported or made with a barrel of oil. We're not going to go backwards as a people, right? I'm not going to give up everything that's made with plastic because whatever initiative is coming out, and we don't like oil and gas. It's just not going to happen. And so if I own that asset, I know that I am going to keep the value of the asset. The only way that I lose my money is if the value of oil and gas drops to zero. Otherwise, my risk is one of timing. It's to say, I own this asset that I need someone else to pull out of the ground. And if they don't pull it out in the time frame that I want or expect, then it'll take me longer to generate the kind of return that I want. But that's your main risk is timing. And that's why we recommend that you diversify so that you can mitigate even that risk. Instead of just putting all of your eggs in one basket per se.
And Thomas, I've got one more question before we advance to some of the timeline slides of the industry that you've got here next, because you did hit on a little bit of what this question is asking. Are the mineral interests you're discussing working interests or royalty interests? So can you just, for the audience that isn't familiar with the difference, just in a simple capacity, break down the differentiation between working interests and royalty interests?
Absolutely. So the royalty interests, when I own mineral rights, right? Again, think of it as being the landlord. When I do when I do working interest, I'm the tenant. So when I own the minerals, I'm leasing out my property. When I'm doing working interest, I'm paying for the right to be able to drill, and I'm also paying the cost of the well. The mineral owner doesn't pay any cost. They get a free ride for every new well that gets drilled. Okay, so they're going to collect a royalty somewhere typically in the 12.5% to 25% of what's generated from selling that barrel of oil is going to go to the mineral owner. The lion's share, that other, let's say 75%, is going to go to the operator, the oil company. They're going to assume 100% of the liability of drilling that well and 100% of the cost. So as a mineral owner, you could have, horrible disaster, the rig burns to the ground, oil everywhere, whatever. environmental kind of issues, the mineral owner wouldn't even know that it happened. The oil company assumes that risk and that liability. But in doing that, that's where they're going to get, like I said, the lion's share of the revenue. They're also going to get more favorable tax benefits. So we'll talk about the Roth conversion, which is probably one of your biggest tax benefits with mineral rights, besides a 1031 exchange. But if I'm looking to offset my active income, then I want to drill wells, because I'm going to be able to write off anywhere from 75 to 95% of my investment in the year that I make the investment. And on top of that, I'm putting my money into an asset that will generate revenue for the next 15, 20 plus years. So that's really why people will choose to invest in the working interest, is they'll accept the additional risk to be able to offset their active income and add additional cash flowing assets to their portfolio. So just kind of think of the two sides. Your working interest is high risk, high reward, less so now than what it was. Your minerals, I'm writing one check and never have to worry about anything again. They just keep drilling wells in my minerals, and my revenue just keeps growing.
All right, we'll get back on track here. I know your next few slides had some dates on them, so I'm assuming you're going through kind of the industry, not forecast, but kind of explosion since what we start here at 1960s.
Yeah, so we always try and bring it back to something that people are familiar with. And so in this slide, this is actually a picture of downtown Dallas in 1960. And so, what I want to kind of illustrate here is the opportunity that we see in mineral rights. Now, if we were to go back to 1960, imagine how much it would cost, even with that kind of development, how much it would cost per acre to be able to buy something in that space. Now we jump forward several years to 2000. You see that same area is more developed. How much is it going to cost to purchase an acre of land in 2000? Jump forward even further, we're looking at 2021. Now you're not even buying an acre, you're paying per square foot. So if we could go back to that 1960, knowing what we know now, I'd gladly pay whatever they're charging, because I know that it's going to be worth so much more, going down the road, right? When we look at the Anadarko Basin on the next slide, this will show us the same kind of story. The Anadarko Basin, as mentioned earlier, is in Oklahoma. This is really our bread and butter. This is where Eckard finds the best opportunity for us and for our investing partners. But in 2010, we would say that there was still a good amount of risk in investing. Not just timing like there is now, although that was certainly higher, but just risk in drilling a vertical well and it not being successful, because there was a lot more, there was a lot less success in drilling vertical wells at that time. Now, if I go buy an acre, or I go buy a full section, right, 640 acres, and someone comes in and drills a well and it's dry, well, I've just condemned that area. So I think I'm doing good because I know where they're going to drill. But if those wells don't produce, then I'm sitting on an asset that isn't worth anything. So that was a lot. There was a lot of risk associated with that in 2010. Now, each of these red dots and green dots represent vertical wells. Okay, so you could see before there really wasn't a whole lot in the basin. We jump forward 10 years, now we're really seeing where all the activity is, where these operators, these oil companies are finding the most success. So each of those squares there, the little ones, represent a square mile. I need 2 square miles to drill a typical well, because I'm going to drill down 2 miles, I'm going to drill out 2 miles. So it looks pretty crowded here, but you can still see quite a bit of white space in between those wells. You also see that there are little lines attached to some of those wells now. Those represent horizontal wells, so they're not just drilling straight down in the ground. They started drilling more horizontally, like I said, down 2 miles, out 2 miles. We jump forward once again, and we're able to see even further development in the basin. You know, we're looking at 2025. There's still a tremendous amount of white space, but what we've done is de-risked that area even further. Now, we could go buy really cheap minerals out in Caddo County, up in Oklahoma County, but we would be sitting on our investment for quite a while, because what happens, just like in the previous pictures of Dallas, is you're going to get your infrastructure start from a certain point, and then it's going to expand outwards. So if I want to go drill way over in the west part of Caddo County, I've got to set up my pipeline, my saltwater disposal wells, my electric, all of that. Whereas if I already have that set up, then I can just expand gradually from there and keep my cost basis down. So when Eckard buys, if we see a good opportunity outside of that core, we might purchase a little bit of it and blend it in with some other acreage. But for the most part, we're buying right there in the core, that sometimes referred to as the tenderloin of the basin, because I want to buy something that is I guess we'll say has a high probability of getting additional development within a relatively short amount of time. But I also want something that's going to continue to produce and have future development over the next multiple decades. So this is the opportunity that we see. Now, as I kind of mentioned or alluded to earlier, the objective of our company is not to just go buy something and sell it to you. We want to grow our own energy portfolio. Well, we realized very quickly we can more efficiently do that by bringing in outside capital. We didn't want to use loans, right? Because I don't want to be basically beholden to a bank. I want to be able to find other like-minded people that are going to recognize the value like we do, and basically go in together purchasing these assets. Now, of course, we put our 100% skin in the game by buying it ahead of you. So we show you how bad we want these assets, and then we ask, if you can trust what we're doing, you like the space, now's the right time that you come along with us. Now, the last thing that we'll cover as what's specific to this webinar and you guys using your IRAs, and Corey had talked about this earlier, is the strategy of using a Roth conversion. So we don't have to stick to this slide for too long because Corey already talked about it, but you can do a Roth conversion with really any kind of asset. It doesn't even need to be self-directed. If you had a regular IRA with Charles Schwab or whoever you have it with, you could do a backdoor Roth conversion. For the most part, if you're on this webinar If you're accredited, then you've likely grown out of being able to contribute to a Roth account directly. But the IRS allows you to move money or move assets from a traditional IRA into a Roth IRA. Now, the strategy that we follow, and a lot of our investors will follow, is they will purchase the minerals in their traditional IRA. They will then take advantage of the way that minerals are appraised. Now, there's market value, which is what Eckard buys and sells off of. And then there's what we call bank value. If I was to go collateralize it, how much would a bank tell me that it's worth? Well, the bank is going to be much more conservative than the market. Essentially, the market's saying, look at all these probable scenarios, right? New wells that are being drilled. The bank says, yeah, but what if none of that happens? How much is it worth? Well, typically, you're looking at least a 50% discount. Oftentimes, it's much higher than that because the bank doesn't care about future development. They care about collecting their interest and getting paid back on the loan. So the strategy is this: I purchase in my traditional IRA, I get a third-party appraisal. They appraise it and reduce that value on paper. I then do my backdoor Roth conversion. So I call Corey and tell him, hey, I need you to take this new value that I just got, lower the basis of my investment, and then I want you to move it to my Roth account. Well, they do that. Now, all the revenue that's being generated by that asset is going into an environment that is tax deferred. And when I pull it out, it's coming out tax free. I've also, as Corey mentioned, when I move that money from a traditional into a Roth, I create a taxable event. Well, if I invested $1 million into mineral rights and I was just to move it over without doing the appraisal, well, I move it over and it's like adding $1 million to my earned income that year. If I do my appraisal and say it comes back at $500,000, well, I've just saved $500,000 worth of taxes by paying a nominal fee to a third party to get it appraised. So this is really where the value or the tax benefits come in for mineral rights. And you got to think too, what kind of assets do I typically want in a retirement account? Ones that are very low risk and ones that are cash flowing, so that way I can continue to get that revenue. If it's in a Roth IRA, I can generate it tax free. So I'll stop there again. That's the last thing that I wanted to cover. So I'll open up the rest of the time, however long you'd like, Corey, for questions.
Yeah. Well, first off, thank you very much, Thomas, for your information shared with the audience today. I know it's a lot for people to take in if they've never heard about this type of investing, but a lot of them are already real estate investors, as we alluded to, and this is just a sub-asset class of real estate investing and many different considerations. So thank you so much for bringing your expertise to the table. I'm sure that the audience was able to pick up a lot of new information, and hopefully they'll be able to reach out to you if they have any direct questions or want to learn more about what active investment opportunities that you guys have over at Eckard at this point in time. I know there was plenty of questions in the chat just about, as I had gone over with you earlier, what options are available, if any options are available for non-accredited investors. So hopefully you get a few phone calls or emails from people that want to learn more, as I have implored them to do throughout the chat a few different times as well. So some questions I see here, I don't want to take up too much time, so I'll try to pick some of the ones that may be a little bit quicker, easier to answer. Let's see, what is the percentage of gas versus oil in your investments. Is that kind of a standard threshold that you can reference or elaborate on?
Yeah, it's usually about 50-50. It might be 60-40 at any given time. But we like the Anadarko and Permian basins because there is some ratio of oil and natural gas. So it's another form of diversification. If I'm subject to one asset, if it's not doing well, then there's a higher probability that they shut in the wells. So for instance, gas prices, they just sank, right, a couple of years ago. And if we would have owned wells in, say, like the Haynesville, that's all dry gas. Those were the first wells to get shut in. Whereas if we own in areas that are producing oil, many of these wells are going to produce oil and gas at the same time. They hit a separator at the wellhead and they go into different containers. So you're going to have what's called associated gas. So that gas has to come up in order for me to get the oil up as well. So that gas takes priority because it's coming up whether they want it or not. So it really, we look and see not just where are we going to get the most return, but how do we mitigate as much risk as possible? Well, I already told you how to mitigate timing. The other is prices. So we mitigate it by being in areas that produce multiple different products. In addition to oil and gas, when you have this combination, it also produces natural gas liquids, which is even more valuable than natural gas. We get to profit off of all of that.
And speaking about pricing, a question here, are mineral right costs tied to the price of oil?
Yes. So to go actually acquire minerals, it's not, I guess we could say it trails prices. Just like anything, when prices drop, sellers tend to gradually drop prices, whereas when prices go up, then sellers will immediately increase prices. Okay, so it trails it. One of the things that, well, I'll mention two other things that directly impact it. One is an advantage that Eckard has over many of our competitors, or anyone that's buying minerals, is we're cash buyers. So just like, you know, you have a cash buyer for your rental property, we're able to make an offer and close pretty immediately. That gives us a ton of leverage to be able to get good prices, just because it's not a bunch of red tape that they have to go through. The other thing is going to be as private equity and other investments entities get into the industry. So what we've seen over these past several years is that there really hasn't been a whole lot of competition. Where most people are buying is going to be in the Permian Basin. And so, you know, they will, it's a great basin, lots of oil and gas, but there's a lot of competition there driving up prices. And so we've been able to just, you know, focus on the Anadarko primarily and pick up minerals at a very low cost basis, because we're one of the largest buyers of minerals in the state. And so we've been really setting the price point and the demand in that area.
All right, and I'm going to string three questions together as kind of our final item for you here, Thomas. How do you determine if there is gas and oil underground before buying the rights? And then a second question that correlates directly to that. Who is doing the research to make sure that you own the actual rights, I guess, from a legal perspective? And then the third aspect to that, what is the risk if the well is dry to the investors? What is the risk to the investors if, the well is dry when it's drilled?
Mm-hmm. So our acquisition team consists of geologists, petroleum engineers, and landmen. All of them have to give a thumbs up before we buy something. So the landmen, it's not like the show. They're not getting chased by the cartel. They are spending a lot of time on the computer, knocking on doors and going into courthouses, checking title and deed, making sure that we own what we say we own, and actually that I should say that what's being sold is what they say is being sold. Okay, before we ever buy it, we go all the way back to inception to make sure that there's no liens, there's no disputes on the title and deed, to make sure that it's free and clear. Our geologists are going to evaluate data from that basin. We're subscribed to just about every database you can think of that relates to oil and gas, so that we're able to see what's going on under the ground. So we're looking at other wells that are put in the ground, wells that are drilled in the minerals that we're looking to acquire. What have they done? When were they drilled? What kind of technology was used? Who was doing the drilling and fracking? Because I will point out that's just as important as whether or not there's oil or gas in the ground. Kind of a horse and jockey type situation. You want a good horse, you want a good jockey, otherwise you're not going to win. We could have tremendous amount of oil in the ground, but if you have a company that cuts corners on their fracking, doesn't put enough sand into it, whatever, then it doesn't really matter how much is there. They're not going to get as much out as what they could be. So that's something that we're also evaluating. But our geologists are determining what's under the ground. Our engineers are determining the ability to extract that oil and gas. So remember, we're buying this with our own money, and so we are very highly incentivized to make sure that these assets will perform and that they are what we think they are and what we say they are. So yeah, a lot of work goes into just looking at these minerals, and I'd say we probably turn down anywhere from 80 to 90% of what we look at, because everyone has to give their thumbs up. Might be really great wells, but the title isn't clear, or they want to charge more than what we think it's worth. We have a very tight buy box, and if something doesn't fit into that, then it's a non-starter. We aren't going to, we're not going to sacrifice our standards because something seems to be really good. And honestly, we've probably missed out on some deals, but it all works out in the end, because we've definitely missed out on some bad opportunities, some pretty major losses that looked better but just didn't fit our buy box.
Got it. And I mean, having that tight buy box is a great representation of how a company can stay in an industry and doing this since 1985. So definitely applaud you and the Eckard team for keeping that going, and having a firm stance on what you will and will not invest into, and really bringing that to the table for these third-party investors through their retirement accounts, or people doing this through their savings, whatever it may be.
Absolutely.
So we do have a few other questions, but unfortunately we are out of time. So for everyone left with questions that they want to address, again, Thomas's phone number and email address, that's Thomas L at Eckard Enterprises, correct? I think someone asked if it was an L or an I, just for good measure.
Right, yes, thomas.l at eckardenterprises.com. You can also just text me on that 321 number if you prefer. Either way is good, but I'd say, even if it's, I've kept some time open after this, because I know a lot of people, while it's still fresh, kind of want to ask those questions. So I'm open to jumping on a call or addressing emails right away. So I'd say don't hesitate to send over questions even right away, and we'll get those worked on for you.
Awesome. And for all of you watching live, the recording of today's presentation will go up onto Advanta's YouTube channel within about 1 day. And you can email myself if you'd like a copy of the slide deck. Please feel free to reach out to Thomas if you have any further questions. Again, he just let you all know he's got time immediately after this presentation to speak with you or answer your questions via text. Thomas, thank you again for coming on today, bringing us some great insight into your industry. I look forward to having you on again in the future, and hope everyone has a great rest of their day, and happy 4th of July later this week. Thank you.
Thank you. You as well.